for trading as always. And I think this is going to be a very interesting webinar because I think moving averages are very, very interesting information they provide. And you probably noticed in the live trading room if you visited that those are definitely present on the chart. So very interesting topic. Before that though, the risk disclaimer explaining that trading foreign exchange, and just as any global financial market, is considered high risk and may not be suitable for all investors. Please seek the advice of an independent financial advisor for more information on that. And this webinar is for educational purposes only. So indeed, well today, once again, this is Admiral Markets, and before we actually kick off the moving average presentation and go into all the details, I'm going to say hi to Michael. Good evening, Michael.
Good evening, everybody. Good evening, Nenad. Good evening, Chris. I welcome everybody who decided to join us on this webinar on this fine Tuesday evening. My name is Michael Onhoff, and I'm a client relationship manager for Admiral Markets. My job is in essence to make your trading environment as good as possible. You can always reach me on my email, on my Skype, also on LinkedIn as well. Today we're going to have another episode of Fun with Forex, and we're going to talk about most valuable companies. We had the first part of the discussion this morning, and now it's the second part. So in the first part of the topic, I spoke about the most expensive brand names and the biggest companies in the world in terms of market capitalization. And both of those places, the biggest market capitalization and the most valuable brand, currently belongs to Apple. Apple is right now battling with Exxon and Google for those first places, but this is the first place right now. I also talk about how Apple, Exxon, Walmart, General Electric, Microsoft, Google, and Coca-Cola, all of those brands, all those companies are presented on our Admiral Markets, Admiral Standard CFD section account. So if you would like to trade on the difference in the price of those companies, you can always do so on Admiral Standard. So the second part of the topic is going to be dedicated to one company, which is historically the biggest company in the world, which is not presented on Admiral CFD. And a lot of people who send me their emails were correct. I'm going to be talking about the company which is the most valuable in history adjusted for inflation. And this company is the Dutch East India Company, which was founded in 1602. It was the world's first publicly traded company on the world's first stock exchange, and it started off as a spice trader. Its competitive edge was the largest fleet shipping goods between Europe and Asia, and in the 17th century, it grew tremendously thanks to rampant speculation on the value of tulip bulbs, about who I spoke last time. So the cold tulip mania craze foreshadowed the internet.com bubble, and like its more equivalent, it eventually burst, but not before making the company the most valuable in world history. So what happened was, when tulip mania crashed in 1637, the company went back to its spice trading roots. It ceased operation in 18th century. So it was adjusted to inflation, and the price of this company is $7.5 trillion. But of course, it does not exist right now. This is why we don't have it on Admiral Standard. Thank you very much for listening to me. I'll now pass the microphone to Chris and Anna, who will continue with the rest of the webinar. Thank you very much for your attention. I'll see you tomorrow.
Thank you so much, Michael. Alrighty, so today a bit, of course, earlier than usual, not the time-wise, but today that has to do with the fact that the U.S. has a public holiday, and I'm joining them with a day off. So that's why we're having it early. Otherwise, of course, we'll have it every Thursday as usual next week too. And today's session is about moving averages, but what specifically are we going to discuss? Well, we're going to take a look at what is a moving average, first of all, what types of moving averages we have, and how do we actually use them. And that is explained, for example, by using in trends, support and resistances, and maybe even when trading. So that's all lined up for today. But first of all, what is a moving average?
Moving averages are basically the time series of data from several consecutive periods. Chris gave a nice introduction to moving averages, and I won't bother you with strange formulas. I won't bother you with many different kind of things concerning moving averages, which are not very comprehensible for people who don't do mathematics and algorithmic calculations. I will be presenting facts that are based on backtesting and are based on historical data. So moving averages are the time series of data from several consecutive periods. They are called moving because the data in it is constantly recomputed. When paper trading got involved in actually in the trading business some decades ago, we didn't have that possibility to calculate moving averages by computers because computers haven't been accepted widespread. There were really absent of we were in absence of technology, and we couldn't compute exact science into those moving averages. So basically we needed to go by paper trading, applying strange mathematical formulas which are very unknown to most of the people, because those who didn't and who haven't studied mathematics or economical mathematics do not know about those formulas. So today, when we are having an interbank market, when we are connected with all sorts of information technology, it's very easy for us to compute and to watch the screen and apply moving averages. So one definition more is that moving averages are mathematical equations used for reducing the effect of temporary variations in data and improving the fit of data to align, a process called smoothing, to show the data's trend more clearly and highlight any value above or below the trend. That, translated to common language, that means that we use moving averages in all sorts of different forms. Basically, I will explain how moving averages are basically used, but let's say that most of all they have their value in trend calculations. They determine the trend. They're giving us the cue where the trend is heading, but that can be a double-sided sword, double-edged sword. I will explain also why I think so, and that is my opinion. So I will tell you what I think of moving averages basically. Also, it's very important to know that moving averages define momentum, trend, and basically what I use moving averages for are to define dynamic levels of support and resistance. So that means that we usually highlight any value above or below the trend. On the next slide, we can see what sort of moving averages we have. On MT4 default platform we use for trading, there are some moving averages basically which we are accustomed to. And what I think is they can be pretty good if we know how to apply it, and most of the time it will be enough for us to use those moving averages. But what I want to say, there are also a couple of more moving averages which I will mention, so we can use it more effectively than MT4 default moving averages in some trading systems. Simple, or SMA, is a standard moving averages, and it is computed by forming the average price of a currency pair over a specific number of periods. So let's say that a 10-day moving average is basically the 10-day sum of closing prices divided by 10. It's usually taken as closing price. The characteristics of this simple moving average is that it's lagging heavily. So it can only be used, and my usage of simple moving averages is basically I can use it for, and I use it some time ago as dynamic levels of support and resistance. I will show you that later, because simple moving average is the most lagging moving average of all MAs, and because it's lagging, it cannot give us a clear entry. It's better to use it as dynamic levels of support and resistance, and later I will show you the numbers which you can apply to your trading system or method. And those moving averages which we will tell you about are pretty constant, and give you an excellent levels of support and resistance. That is concerning simple SMA. I don't recommend it using it on let's say low time frames and as an entry indicator. They're used as dynamic levels of support and resistance. Exponential moving averages is more effective than SMA in its calculation because it applies more weight to moving averages and thus it reduces the lag. It is lagging, but not as heavily as SMA. Why do we use exponential moving averages? Because it's maybe most widespreadly used of all moving averages. A majority of traders use EMA, and because most, I don't say it's the most effective in its calculations, but because most traders, very majority of traders use it, that means that they are maybe the most effective of all. But it doesn't mean that other methods of moving averages are not as effective. It only differs by why would you use moving average. Would you use it for, let's say, entry as a crossover, which of course I don't recommend, except one. Would you use it maybe for a dynamic level support resistance? Would you use it for placing a stop loss? So it depends why you would use a moving average. Most simple trading systems use those low valued moving averages for determining entry points. I will show you how you can do that, but only as momentum, not as an intraday entry trade. That is most important for you to know, that moving averages are not just simple indicators. You don't use it just for entry points, and I will explain that. So that is about exponential. It's mostly used, most heavily used, but that doesn't mean that it is most effective. Smoothed moving average, or SMMA, gives the recent prices an equal weighting to historical prices, and that is a very good thing. The calculation takes all available data series into account rather than referring to a fixed period. That is achieved by subtracting the prior period's SMMA from the current period's price. So what that means, it means that it's less laggy than EMA, and it gives more precise data for current price. That is why some traders use it more as a crossover than EMA. So if we trade moving averages as a crossover, we will mostly use it, let's say, smoothed moving average than exponential, but also if applied on specific time frames and specific periods. And the last MT4 default MA is linear weighted MA, or sometimes known as WMA, or weighting moving average. Some refer to LMA, some refer to LWMA. On MT4 it's LWMA, but it's also as weighted, or it's the same basically. It is used basically as EMA or SMA with less lag. It was very popular, but it's lost its popularity when EMAs were presented, and it's very dangerous to use those in flat market. So I stress it again, those MT4 default moving averages are not to be used in ranging market. There is only a couple of indicators considering moving averages that can be so effective in ranging markets. Not as profitable indicators, but to define a ranging market. So some of indicators can define, of EMAs or MAs, can define ranging market, but not all of them. I will show that. So all of those MT4 default EMAs, MAs, are not to be used in ranging markets because it will kill your account. That's for sure. Moving averages do not take spikes into consideration, so it's very unnatural for traders who trade trend trading or counter trade trading to use moving averages by default. We need to apply additional filters, okay? And always use MAs with additional tools. You cannot use just the MAs and say it's enough. If you want to use indicators on your chart, you need to use MAs coupled with other indicator tools. If you remember webinar where we talk about indicators, we have momentum indicators, we have lagging indicators, okay, and we have support resistance indicators. Momentum is leading indicator, MA is lagging indicator, and support and resistance can be defined as pivot points or dynamical MAs. So simple enough. You don't use MAs simply on naked chart because it won't tell you anything but dynamic support and resistance levels. Okay. Next slide will show us another maybe more advanced methods of calculating moving averages. There is DEMA or DEMA. It's called double exponential moving average. The DMA, let's say, is a fast-acting moving average that is more responsive to market changes than a traditional moving average. It was developed in an attempt to create a calculation that eliminated some of the lag associated with traditional moving averages. DMA can be used as a standalone indicator if used with range bars. That is another topic, but it's very effective if it's used with range bars and can be incorporated into other technical analysis tools whose logic are based on moving averages. I personally apply DMA to range bar charting techniques. Also, triple exponential moving average, or TEMA, is basically triply exponential moving average, and it seeks to reduce the lag of a typical EMA by tripling the weighting of recent prices. It's able to respond to market moves much quicker than EMA or SMA, but because of this, it overshoots the market and it's not as smooth as a filter. Overshooting leads to more whipsaws and unstable trade signals. I don't recommend using TMA because of overshooting. Overshooting is a special term when stop hunts and spikes are reflected as news or rumor momentums. So triple exponential moving average will do good in slow trending markets, but on spike trading it's very bad. I don't recommend using it unless there is a very strong trend on higher time frame. Adaptive moving average, or AMA, is maybe one of the best EMAs which can signal a ranging market. Let's say that adaptive moving average came about as a result of trying to improve on the original concept of exponential moving average. Perry Kaufman expanded on the EMA by multiplying the weighting of the EMA by a volatility factor. That volatility factor is an advantage in adaptive moving average because the indicator seeks to adapt more quickly to the market by indicating when volatility conditions change. It's frequently used as a ranging filter to tell traders when markets are in range mode. You can Google for a well adaptive moving average, and it's an indicator which points the dots below the candles, signaling that range is starting. I don't need to use that because I can tell it by my eye, but for novice traders it can be a nice tool to use adaptive moving average. One of my favorite moving average is Hull moving average. Trader Alan Hull's attempt to solve the problem of lag versus smoothness comes in the form of Hull moving average, or simply HMA. Hull uses several weighting of averages in his formula and claims by doing so he's able to reduce lag and increase smoothness at the same time. I can verify that is the truth because I use it also in range bar charting, and it's almost non-lagging, and it also can be used effectively with range bar charts. I use it in range bar charting. It can be very effective to find a trending market, and of all moving average, this is my favorite. Also, there is Zurich moving average, or JMA, it smooths price when tracking the chart's rapid up-down gapping action. It is less prone to lag, but some backtesting shows similar results with weighting moving average, and it's almost lag-free as HMA. So basically, what I would say about Uric moving average, there are some methods that apply moving averages very effectively, but again, all of those moving averages can be very, very effective if you use it by a particular template. You need to find out whether those MAs are in a collision or are aligned to your trading methods. There are many trading strategies, many trading methods, but you need to find one which is profitable, or you need to basically trade one method to see if it's profitable or not. By applying that knowledge which you know about moving averages, you can apply nice filters, and I will show you later how you can use also all of those moving averages. So basically, you need to pick one of those MAs and see by backtesting where it's profitable. Most of EMAs don't work well with range markets and periods of congestion because the fitting lines of moving averages fail to denote a trend due to a lack of evident higher highs or lower lows. That is the biggest disadvantage of moving averages. Fitting lines, that means EM lines, cannot find a trend because there are no evident higher highs or lower lows, or let's say lower highs and lower lows. Why is that so? Because moving averages cannot define it, and they cannot spot ranging markets. The only moving average that is able to spot a range is adaptive moving average. So where basically is advantage for one, there is a disadvantage to another. Also, those lines of moving averages tend to remain constant without hint of direction, which happens in a ranging market. And that is when you lose the money. If you trade crossovers in ranging market, you will lose the money. Rising moving average, a line below the market, usually signifies a long, while a falling fitting line above the market signifies a short. That is trend trading, but that is very dangerous in ranging markets, okay? And we will show you later. So that is concerning what moving averages you can pick to apply on your chart or on your template. Also, I can say that moving averages can be used to measure trend strength, momentum on a particular time frame, dynamic support resistance levels, which I recommend, and stop loss placement, which I heavily recommend. Entry as a crossover, not recommended except golden cross, but usually on higher time frames. I will explain later what golden cross is, but let's say that golden cross is deemed to be the most profitable MA crossover entry. It's 50 versus 200 EMA. But most recent studies told us that this was profitable some 10 years ago, up to when basically 15 and 48 cross was found out. So I will show you later this cross versus 1548. I can say that 1548 is golden cross now. So that is the only crossover which can, in my opinion, maybe not the only, because I don't use crossovers as entries. Maybe there are some traders who use, and they can be maybe effective in their trading system or method. I don't use crossovers because crossovers, in my opinion, cannot tell me whether I place a correct entry or not. Those who know, who follow, let's say, my analysis of Forex Factory, know that I use other methods, but I don't say that cannot be effective. I think that there are some effective strategies with MA crossovers, but those are usually found on higher time frames. So for intraday trading, it's not very suitable. Okay,
Alrighty.
Chris.
Totally agree with you on the fact that I don't use it as an entry system per se either. I do use it indeed when they cross over a long-term moving average like a 200 or an intermediate like a 50 as a potential trend reversal or change. So that usually does indeed materialize. Of course, you even then have a whipsaw or two. But if you use it as a trend definition, I do feel that it does provide some good information. I don't necessarily, of course, use it as an entry, and I'll talk about that more later on. Interesting information regarding the various moving average combinations, and there are a lot of them out there. In fact, we can talk a bit more about that. That's what I have here. In fact, personally, I use the EMA, as people who are in the trading room know. And that is my favorite. That never really looked into the hull, for example, so maybe I could do some work on that. But this is my favorite setting. I use that on multiple time frames, and basically I'm always have medium-term moving averages on the chart and long-term moving average, and sometimes a short-term, but not always. Now, the ones I use for the short term are typically 8 or 13 EMAs. I will often use Fibonacci numbers, Fibonacci sequence numbers for the moving averages, which I find a very interesting prospect for using moving averages. In some cases, I also use for a very short measurement of impulse. I even use 1 or 3, but not the EMA, but the typical. That's not the EMA. It's a typical shift 1 or 3. That means it's forwarded into the future. So whatever if it's a 1, that means the typical moving average is 1 ahead of current price. And if it's shift 3, that means that the moving average is 3 forward current bar. So that's to gauge very fast movements. Very, very fast, ultra-fast movements. The 5, 8, and 13 are typical normal short-term moving averages. I always have, though, I don't have those always on my chart. The medium-term moving average is something that I do. And as you know, I'm a big fan of fib numbers, so I use 34, which is a fib sequence number, and not only the close, but an open and high, which therefore create a band of moving averages, and thereby creating a zone, not one specific price level or action. This zone tends to incorporate or hold price action as a support or resistance very nicely. Of course, there are some exceptions with some dips through that, but the band like this is very nice. And I'll show you a chart, of course, in just a second. The long-term moving average could be anything between 100 and 200. In general, though, the moving medium could be anything between 20 and 50. Okay, just that I use 34 doesn't necessarily mean that you have to use it. Many traders use even 18, for example, or a 9 and 18, for example. They use 9 as a short term and 18 as a medium, or they use 10 and 20, very popular combination, or they use 20 and 40 as a river. They have 2, and they use it as a sort of stream. 2050, 9, 18, 36, those are other popular combinations as well. Or if you want to stick to Fibonacci sequence numbers, 55 could even fit. The long term, you could even use 89, like the pound likes to use. So those are all potential possibilities. Of course, the 50 and 200 is often used on TV when you're looking at a big channel, TV channel. You would often see experts talk about 50 and 200, I have a feeling. So that's quite a common usage of that, as well as SMA, in fact, 50 and 200. Personally, I use, again, a fib sequence number, which is the 144, and that is right in between the long-term moving averages. So let me show you a chart now, finally. The green one would be the indication of the long-term one, and the dotted black line here is that short medium-term moving average, the 34. And you can see that it does provide a lot of information regarding potential long-term trend, right? Upside, downside, just looking at the price versus the green line. It also gives an indication about potential trend when the price is above the medium one, with here is a dip retracement deeper, right? Etc. All right, so it provides a lot of information. I just wanted to show you one screenshot what they are. Now I'm going to actually dive into how I use them in more detail. Personally, use the medium-term moving average as a trend definition. So that is on a 4-hour chart personally, and that is what I use as the main trend direction. So if price is above the 34 EMA, it's uptrend. If price is below, it's a downtrend. That's basically roughly what it boils down to. Now, of course, we can use chart patterns and our own observations of charts to see if they're in a range. If price, if the moving averages are flat, for example, and price is bouncing obviously up and down around them, then price could be above it, but that's not a trend, right? That's not enough. We need an angle and we need a direction. Now, you might use different time frames. I use the 4-hour, but some of you might want to use the 1-hour or day chart, depending on how you trade. I also look at the fractal, not only the price, but also the fractal relationship to the moving averages. And I'll talk to you about that a bit more when I show you the screenshot, in fact. And what you see with the range environment is that the price is chopping around its average. Okay, so let me see if I have an example of that. No, I forgot to actually put an example of that. What you would see, let me talk about this last point, when it's a range, is if price is bouncing up like this, up and down, what you just will see logically is the moving average is more or less flat, and they'll be approximately in the middle of that range. Okay, so that's if the moving averages are flat and their price is spiking up and then down around them like this, then basically what's happening is price is moving away from the average. There's no trend, so it moves down. There's no trend, so it moves up again, and it keeps within this volatile, kind of spiky up and down because there is no direction besides the support and resistance of the range. Now let's talk about the fractal relationships to moving averages, and here's an example of the pound dollar. You can see a low time frame, 30 minutes. You can see that once the fractals are below the moving averages, that's when you really get the most impulsive move, in fact. And anytime the fractals are kind of bouncing around the moving averages, that's when you have a more range type of environment. Okay, so that's what I look at. Where are the fractals in relationship to the moving averages? In this case, the fractals are well below the trend definition band. All right, well below it. So it's an impulse. In this case, though, the fractals are above the band, but still below the long-term moving average, which either means we're in a reversal or we're making a bigger retracement. In this case, it was a reversal because it's the pound dollar, and we got upside continuation after that. So we started to use it as support. All right. Let's see other example maybe. In this case, this was a typical range where the fractals are basically above and below, and the moving averages are all basically intertwined with each other. No real direction. Okay, so that's how you can use that, not only price but fractals for that information. What else can you use moving averages? Divergence, in my opinion, as well. When divergence is in play, I am expecting price to go back to the long-term moving averages. That's kind of my golden rule I use to have an idea when the moving averages, when the price has made its minimum retracement that we can expect. Okay, so once price has come back to those long-term moving averages, then I know divergence could still have an effect, but it's basically the minimum effect has been made. So it either can continue with the trend, or it could still make that bigger retracement, but the bigger retracement, has been already taking place. So let me summarize that. We never know if a retracement will happen or a reversal. But if there is divergence, what I expect as minimum is a move back to the long-term moving averages. I'll show a chart in just a second. Let me see, 1 second. Yes. Always, of course, double and triple divergence, the likelihood of retrace is more imminent, especially on a lower time frame. A single divergence has a less probability that price will necessarily go back to the long-term moving averages. So here's an example. We got a huge impulse. The fractals are above both moving averages. And what you have here is a retracement, but the oscillator is a very strong oscillator with, of course, a very bullish price action. And as you know, in the live trading room, we said a break of this top is very likely. It's very, very likely. The question is when and from where. Eventually, we came very close to the 50 fib and then started to use the moving averages as a support to the upside. Now you can see that once we have divergence, which is approximately here, all these tops are already having divergence with this top, we get that move back towards the long-term moving averages, which is this level right in here. All right? Not the first time, not even the second time, but the third time we do make that retracement finally down. Now that retracement, though, is very slow and sluggish and corrective, and in fact doesn't make much pips to the downside. And obviously when we touch this, we make a continuation still to the upside. In this case, it's not always like that, though. Just goes to say that if you have divergence, there is a high probability, especially if it's double or triple, that you do move back to the moving averages, long-term moving averages. And once you've done that, the trend could still continue, potentially, depending on the longer time frame, or we get a reversal. I use all these moving averages on all time frames. That's fine. The difference is, though, that the band here, the 34, I use as a trend definition, and basically the long-term moving average I use as a target for divergence, basically. So all time frames can be used. Okay, so I'll write other answers through the text here. 1 second. Alrighty. Support and resistance. Oh, by the way, one more thing. If a price is using this as a support, when it does have divergence, it will have to pierce through that support, as you can see here, for price to be able, of course, to reach those long-term moving averages. And it does so here. That could be one of the warning signs when it does pierce through it, and you do have divergence, that when the hook back comes, that there's a good chance for a decent reversal trade. I'm not a big reversal trader, but in this case, right in here where I have the red circle, because we've pierced through the moving averages and we had already triple divergence, that move up in this case could definitely be a potential correction for that move down to the long-term moving averages. Now be careful with that, especially on lower time frames. I wouldn't, until you've really practiced a lot, don't even look at it below 1 hour. Even on 1 hour or higher, still want to be very careful and practice this as anything, of course. But that could give you at least a good idea that maybe this upside, you should be careful with buying and be careful with trading this with the trend. Now, support and resistance. Of course, also I use that, the moving averages as support and resistance. We already talked about it, in fact, when I was talking about trends and divergence in specific. And yes, price will pierce through it a bit, but they do give a rough zone. And what I like about it is just the area that it could potentially go to. And I think that's pretty neat how price responds to those moving averages. And I got used to that, and I like it a lot. So it's really very nice trading, I think, with these moving averages, and that's why I use them very regularly in the trading room, because that's just one of my favorite tools. Not only is price important, though, as I said, but also the fractal position towards the moving average gives a lot of interesting information. And in fact, once the fractal, not only price crosses moving averages, but the fractal crosses the moving averages, then it's interesting information. Let me show you a chart. For example, here, all the fractals, price has gone through and pierced through the band here, but be careful. That's not necessarily a reversal as yet, because it's just testing these bottoms, right? It's still using it as support and moving up. The fractals are still aiming at support, but what is the difference here? You can see the fractal is below, the opposite fractal is below the moving averages. You can see here that these fractals are still above it, and these are below it. But this case is different. Both fractals are below it. And that's when you get the bigger trend change. And also note the fact that the fractals cross or are below the long-term moving averages. So that's a lot of information you can read from there. You have various degrees of retracements or reversals on each time frame. Okay? If the price goes back to the short-term moving average, it's a small retrace. If price goes back to the medium-term moving averages, it's a bigger retrace. If price goes back to the long-term moving averages, it's a sturdy pullback or potential reversal. And if then price and fractals, I could say price plus fractals in fact, didn't think about it, but if price and fractals are below the long-term moving averages, we're talking about a reversal. Okay, so different, you can measure the depth of the reversals or retracement by using these moving averages. All right, so small pullback. Let me start here at the very top. Small pullback, small retracement, bigger retracement, or a normal retracement, small retracement, normal retracement, smaller retracements, normal retracement, and here we have a bigger one, a bigger one, a bigger one, right, etc. Now the angle is important as well. That gives you good information about the psychology of the market and what type of environment we are. We already talked about the fact that this can help with the trend definition as well. 3 p.m. angle, it's flat, there's no trend, there's no range. There's a range, sorry, no trend. 2 to 4 angle depends exactly, of course, but roughly in that bracket you're talking about some trend at least. Depends on the situation. And anything more or less, it's a big trend, either up or down. These are the clock. This is the angle of the hand of the clock. Okay. The short term is a bit different than the medium, though. I don't look at the angle for long term. Don't look at it. Not important. That's just too far away, from, in my opinion, from price. All right. So don't use that, but I do use the medium and the short term. And short term has a different meaning though than the medium, because the medium I use for the trend definition, but the short term I use to gauge impulse and correction. And if the short-term moving averages are 2 at 4 p.m., there's no impulse. And if it's at a very steep angle, there's an impulse. And there's a thrust. So that's the difference. The short-term measures impulse, the medium measures trend. You can see, look at this angle, very, very steep here. And the short term is pointing up here, but the medium is still down and still has angle. So the trend is still down. Okay, everything is lined up to the downside here. Also the long-term moving averages. Very nice trend. Still pushes up for one more higher correction, almost going to the long-term moving averages, and then starts to break down again. All right, what do we see here? First, a retracement to the medium, then to the long term, and then slowly but surely, price is pushing above it, and then starts to break to the upside. Now, how about crossovers? What's my opinion on crossovers? So as I said, I don't use it for trading. I do use moving averages because that's dangerous, slow, whipsaws, price retraces often. When you get a push through like this, for example, what does price do? First of all, here it retraces, right? So you would see that often. Here you get a crossover. What does it do? It retraces. So, but what I do look at is for general trend direction. Obviously, if these moving averages cross over here, yes, the trend has changed, right? From here, you can see they were up. This was an uptrend there, and they've changed. Here we had at least some small uptrend. This, nothing. It was a whipsaw. So that's why it's not good for trading, but it could give a potential long-term trend idea. And that is what I do use it for. Okay, that I do use it for that. All right. Now, of course, you have the fractal crossing. So you can look at, not only can you look at, of course, price moving averages and price moving above fractals or below fractals, but you can use it. Moving averages, crossing moving averages. As I said, I only use it for potential long-term trend change directional guidance. That's all, personally, when moving averages are crossing moving averages. And fractals, as we already talked about, and fractals really being used as support or resistance. In fact, maybe crossing is not the right word, but that too could indicate the potential trend change. So here's the euro-dollar upside. And you can see here fractals on the opposite side, and boom, down. Fractals on the opposite side, that only happened here, in fact, boom, upside. And this was quite whipsaw-y, right, with the moving averages quite close to each other as well. The differences between the moving averages as well, providing information. Didn't mention it here, but all that basically helps with reading the market psychology and whether there's a trend and whether there's support or resistance close by. So that's how I use it. Trend, divergence, support and resistance, angle, the gaps, the difference between the gaps, all that on multiple time frames, and that provides information about retracements and breakouts, consolidation and impulses, all right? So very useful information. I think that wraps up from my side, in fact. And
yeah, thank you, Chris. Very informative about those moving averages, those angles especially. I like it really. I know that you are a heavy user of moving averages. That is a good thing. So traders can really learn from us today. I won't go into deeply now as Chris went, because it may create confusion, especially for new traders, because all of those methods require patience, study, and backtesting. So you need to be a follower of a particular method to learn it completely. You don't switch from method to method. Okay. Moving averages, as we concluded, are and can be very, very, very profitable. Only thing which I would say is basically that we can measure, as I said, trend strength, trend momentum, and what I use for especially is dynamic levels of support and resistance. Now we can see how the alignment or the angle of moving averages gives a trend direction or a trend strength. In this particular example, the first arrow points to the points upwards, and that is basically when we have a uptrend. That is a standard EMA, which is used to measure direction, and trend strength, that is 100 EMA. Also, when we see those spikes after the big candle to the downside, we can see that the trend has changed. So when the moving average starts to fall to the downside, we can see the angle of the second arrow. we can say that that is a downtrend. The thing is particular that those strength measurements are just not enough to apply it only as a single indicator on your chart. After that, we can see the third arrow pointing that the market is flat because moving average is flat, and indeed it goes sideways. And the fourth arrow again gives us a clear trend strength because it goes to the upside. So judging from these moving averages, it can be used effectively as a strength tool, but it is not very effective if we use it as an entry. It gives us a clear, a nice trend direction, even it hints us to a ranging market, but it does not give us the entries by itself. So on the first arrow, I don't know just by applying this moving average where I should enter. Also on the second arrow, I again don't know where I should enter. That is why we use other methods for entries. So in this particular example, we can see that measuring trend strength with 100 EMA on 1 hour time frame can be nice and effective method. Now let's see the second slide. The second slide will show us how to get a momentum. Chris uses 513. I have used from time to time been using 612 cross for momentum. Now I'm not talking just about entry. Maybe if you see this picture, this chart, you can think of this as an entry. No, 612 cross for me indicates momentum. I use it on my Camarilla MACD, and it is one of the signs how to calculate momentum. It is not by any means entry. It is a momentum. We can see that the momentum shift is generated by 612 cross, but also by big, strong candlesticks. If you watch those arrows, strong candles usually make it a crossover. Not any particular candle, but candles that have been aligned with, let's say, accumulation candles that have been aligned particularly in one type of pattern, that after the breakout, if it happens to be a big strong candle, that will give us probably a successful momentum gauge. And in this case, we can see that maybe I can count it. It's 1, 2, 3, 4 of those arrows which are indicated were basically big momentum candles. And they are definitely a gauge for a nice momentum outbreaks. You can see prior to those big bodied candles and prior to crossovers, you can see that the price has indeed been in some sort of spiky mode, of a ranging mode. And if you draw the lines, I didn't draw it on this chart, but you can do it after, you can find triangles. So if you connect those triangles within those candlesticks, you can see how the price reacts to those basically outbursts. And you can see how momentum is indeed shown by 612 cross. You can see the momentum strength on 612 cross. Some traders use it heavily as basically, now Chris is pointing out chart patterns which can be used as 612. Excellent. We have triangles, bearish wedges, megaphones. You can clearly see it in my analysis, which I post every day also on Forex Factory and Admiral Markets blog, that I use chart patterns along with these 612 crosses. Those crosses which are aligned by chart patterns gives you double confluence and double confirmation for your trades. Using 612 crosses, if applied correctly on your templates, can give you potential nice setups for breakout trades. So in this example, we can see some. I was telling you that some traders use it as an entry indicator. It can be used as entry indicator, 612, same as 513. But I have found it myself. Then in the method which I use, 612 cross for momentum gauge is more effective than entry cross. And also 612 cross on 1 hour and 4 hour time frame gives me a nice trend direction, okay, along with momentum. And if I find a nice pattern along with it, that is sure hit, okay. So 612 cross for gauging the momentum. And now finally, I want to, before I start with golden crosses, this was one of my favorite moving averages, moving average that defines its three. I have three dynamic support resistance levels gauged by moving averages, and it was my preferred method of determining support and resistance levels. So I have 30 as a blue, 50. Those are all SMAs, and 100 is green. So blue, red, and green. When those 30, 50, and 100 are aligned, I can say that we have a trend. The thing is, this method for determining dynamic support resistance works very, very good, and it works excellent, I can say, in big trending markets. This particularly was good when euro was falling from the heights in the year of 2009, 2008, that we had particularly very strong trending markets. As you know, conditions have changed, but it doesn't lessen the strength of this particular method. I frequently use dynamic support and resistance levels, and I can advise you to put 30, 50, and 100 SMA on your chart and see how it goes. It can be a nice add-on to your method. I didn't cherry pick this chart. I have just manually pulled the chart from my right to the left, and I got this result. Okay, so we can see that it really does wonders in big trending markets, strong trending markets. We can see that if you look for trend trades around SMAs as retracements, we can see that the price really reacts nicely around green and blue dynamic support resistance levels. If it passes above, let's say in downtrend, above the green, I can say that that can be a very big pullback, and it usually can be the end of the trend. We can see that the first arrow is pointing out to nice retracements towards blue and red MA, and finally is pointing out to a big retracement in downtrend to green MA. After that, we can see that the trend has indeed resumed. So I want to see retracement at least to blue, red, and finally it can be green, but as long as it in downtrend is below the green and all three of them, it's a nice downtrend. If the price goes above all of three MAs but not below green MA, we can say that we are having an uptrend, and you can see it from these pictures right there. So we can see in this kind of strategy you can apply stop losses, of course, below swing lows, swing lows or swing highs which goes above or below green MA. On longer term trading, and especially on swing trading, trailing stop is good thing to use. Okay, I would apply my standard method of stop loss in here. Let's see the first arrow. We have a nice downtrend. As long as we are in downtrend, I would place my stop loss above previous swing high, of course. That would be my stop loss for short trades. If I see that the trend is going upwards, I would of course place my stop loss again again prior to swing low, just below the last swing low. So starting from the second arrow, we can see that basically we have a start of uptrend, and of course I would place a stop loss just below the hammer which I pointed out with the second arrow. The third arrow is just continuation, shows a continuation of uptrend. So this method works good. You can apply it on your charts. So it's 30, 50, 100. I have marked it with blue, red, and green, and it gives me a trend direction along with nice dynamic support and resistance levels. So entries can be found around those moving averages on retracements. Okay. Next slide, I will talk a few things about a golden cross. What basically is a golden cross? The golden cross is usually worked out in trending markets, but as a crossover. By golden cross, we define usually a bullish crossover, but we can also say it works good as a bearish crossover. 50-200 cross of EMA was very effective until 1348.5, or let's say 48 cross has been applied. Now I can say by backtesting that 1348 EMA cross do better job than 50. I will show you this example, and we can see in this chart how 50-200 EMA cross gave us one loser and two winner trades. But the thing is that the first trade when we spotted the golden cross, bullish golden cross, we can go back to previous slide just for a showcase. In this example, we can see that the first arrow is really a huge loser, because the cross given as a trade when trend has already began to retrace. And what that means is we can see that EMAs are really lagging, not as heavily as SMAs, but they're lag. The second trade was again a winner, but that is a huge downtrend, and the golden cross picked up entry around the middle of a downtrend. So it can be good in big trending markets, but when trends are not strong, that do not work good. That doesn't work good. Especially we can see that this second entry has been if you ask me, very, very bad, because it was picked up at the very middle of that downtrend. And the third entry was much better than the first two, but yet again we can see how those moving averages lag. The golden cross also lags. On the second example, we can see 1348 cross. That is the next slide, and those lines stay the same as we had for 50-200 cross. We can see that 1348 is much effective. You can see the first arrow points to a good entry, to a nice trend ride. The second arrow points to a nice entry with some relative drawdown, but again it could have been profitable. The third and the fourth entries are absolutely brilliant. Also, each of those subsequent entries have been much more profitable than basically 50-200 MA. Both are done on daily time frame, okay? Both are done on daily time frame, but you can see how those crosses work. So I can say that 1348 cross is indeed golden cross, but as same as every other, it lags. So now we are showing you how those entries are good, but also in the same moment they are lagging entries. So green are very good entries. Those red are, let's say, they're really laggy entries because they're already shown when the trend has already picked up. and those blue smiley entries are basically, they can be so-so. The biggest problem using of these moving averages is where our exit should be. So that is the method which I don't suggest that you use it widely, but let's say that that can be effective if you are patient enough. But yet again, you need to wait long for those setups, and you need to wait for days to close your trade. This is what I personally don't like. Okay? Yeah, exactly. And one more thing I would like to say, just a few things about those golden crosses, because I know that many traders try to find out a nice golden cross that will give them profitable trades each time. Basically, what I want to say, that golden cross was used to be more as a bullish cross than bearish. So it was widely used as a bearish market momentum and entry. Golden cross presents a bullish technical formation that supports upward momentum in current trend or a potential turnaround in downtrending market. The fact is that 1348 cross is stronger than 5200 by backtesting. You can apply MAs on various templates effectively. You can use golden crosses as long as you apply additional filter to your trading strategy, especially target prices. Because if it gives us good entries, the problem is if the entry came too late, our target price, we may miss potentially better profitable trade than we place by golden cross rules. Also, the advantage of the crosses is that majority of traders still use those MAs in different forms. I don't use it personally as entry. I use only 612 as momentum. Some time ago I used 30, 50, 100 SMA as dynamic levels of support and resistance. And I have witnessed many times in my trading career that moving average crosses led to big drawdown. So if you ask me, use angles, as Chris said, to determine trend strength, to gauge momentum, and dynamic levels of support and resistance. That was all considering moving averages. You can apply moving averages on any different template effectively, but you need to know how to use it, whether you would use it as, which I don't recommend, entry, which I recommend dynamic levels of support resistance, and which I of course recommend as strength. If you have any questions, we can answer it now. I think I have answered Igor's question, but maybe Chris, it's also for you. Do you use trailing stop loss on edge of long-term MA?
What is the edge? Do you think, T? The edge? Oh, you mean like?
Probably the peak. I don't know. And edge of long-term. Maybe the peak of the most prominent point of MA. I don't know.
Not the long term. No, I don't use the long term moving averages for trailing stop. I do think that an intermediate or a short term makes sense, depending on how aggressive you want to capture that momentum, or if you still think that the currency could continue after a correction, let's say a bull or bear flag. You could use either the short or medium term. That would depend on the higher time frames. Those both, though, make sense. As I said, depending on the circumstances. The long term wouldn't be using that indeed.
Also, we have a question. Can we get a slide of this presentation? And I need further learning. We cannot give you the slides, but you can. This webinar is being recorded, and this webinar will be uploaded tomorrow on Admiral Markets website. So you can of course go to Admiral Markets webinar education and see it again. So get a screenshot or anything. So you can use that, of course, but only after this webinar is uploaded. Unfortunately, we cannot give you the slides because they belong to Admiral Markets. But of course, as I said, go to webinars education. You will see that this webinar is uploaded, and then you can take screenshots. Why not? Next question was, how can moving averages for different time frames be used effectively? Now we didn't explain you about particular trading system or trading method. We explained you how you can use it effectively. So for trend strength, for dynamic levels of support resistance, and for gauging momentum. So try one of these combinations on any strategy you'll be learning, and you will see how effective it is. Igor is asking you like 5 pips outside of MA.
Yes, and that does make sense. That does depend also on the time frame, absolutely, because you know, a breach of a fractal or MA does depend as well on the time frame. But I would say if you're looking at 15, 1 hour, that would make sense. Maybe 1 hour you could just be a tad more, maybe. If you're looking at it daily, obviously, then the price could go through that a bit more.
Okay, I will watch again. Great, thanks for your help, guys. God bless you. Thanks, you are welcome, guys. And I will take this opportunity for any of you who attended my yesterday's webinar. That won't happen again. The thing that we had our broker webinar yesterday, we have taken some measures in front, so I can say that it won't happen again. So you'll be free to watch session recaps on all those webinars with stress-free. Thank you very much again for listening to us. Thank you very much for supporting us in Admiral Markets. We will talk to you very, very soon, and we will have a Thanksgiving Day. After Thanksgiving, we'll be ready to rock again. I think that I have my personal webinar tomorrow, but then we are getting back as soon as Thanksgiving Day finishes. I think it will be next Monday when we will have a session recap. Then me and Chris will make another webinar for you. So thank you for staying with us. I wish you many, many green pips.
Yes, thank you for being here, and still tomorrow. I'll hopefully see you then in our session, live session, and otherwise see you next week. Cheers, everyone.